Welcome to the Deep Dive. We're here to cut through the noise and give you the insights you need. Today, we're tackling something really fascinating, this whole idea that kind of lures investors in the hunt for that one amazing fund manager, the rock star investor.
Yeah, that magnetic pole.
Exactly. We've all heard those stories, right? These legends who supposedly have the magic touch, always leading the market. It's a really powerful dream, finding that genius. But our mission today is to really dig into this myth of the star fund manager. We want to challenge that whole idea. We'll look at why chasing these top performers, well, it often ends in disappointment. And maybe more importantly, how you can build a strategy that's, more reliable, something that doesn't just hinge on luck or finding some rare talent.
It's fascinating, isn't it? Beyond just the money, it taps into this really deep human thing, wanting shortcuts, wanting to find that exceptional person. We see it everywhere. And finance is definitely no exception. For this deep dive, we're leaning on some really solid groundwork. Insights from John Bogle's Common Sense on Mutual Funds, Benjamin Graham's classic, The Intelligent Investor, and the very practical All About Asset Allocation.
Great sources.
Yeah, and they offer let's say, a different angle, a more grounded one, frankly. We're going to uncover what Bogle calls some relentless rules of humble arithmetic.
Humble arithmetic. I like that.
Rules that really govern investing. And once you get them, it can totally change how you think about your money.
Okay, so let's start with that appeal. The superstar manager.
Yeah.
We hear about the Peter Lynch's, the John Neffs, Michael Price. These names that, looking back, seem like investing gods.
The legends.
But here's the thing. Our sources really hammer home these famous names. As far as anyone knows, they were never picked out before they became successful.
Right. It's all hindsight.
They became legends after they'd already done it. Which makes you think, doesn't it? Have you, listening right now, ever caught yourself trying to pick the next big winner? Staring at performance charts, thinking, I can spot the next genius.
It's so tempting, but it really flags a key problem, doesn't it? How hard it is to actually predict who's going to succeed.
Yeah.
Our sources talk about, human fallibility, but also just the sheer nature of competition. It makes consistently beating the market incredibly tough.
So what happens instead?
Well, what we see over and over is this thing called reversion to the mean.
Oh, yes.
Basically, yesterday's high-performing funds become tomorrow's laggards. It sounds like just a theory, but it's a really strong historical pattern.
Okay, give us an example.
Sure. There was this one study, pretty telling. They looked at 34 funds that were in the top quartile, the best performers.
Right.
Over the next 10 years, guess how many stayed there? Only 4. 30 of them reverted. They lost that edge.
Wow, 30 out of 34.
Yeah. And flip it around. 33 out of 34 bottom quartile funds actually got better relative to their peers.
So the bad ones got better, the good ones got worse, mostly.
Exactly. As the source says, reversion to the mean is sending a powerful message about the futility of evaluating funds based on their past returns. The market just kind of levels things out.
Okay, so finding a star manager beforehand is like next to impossible. But let's say you did. Let's just imagine you got lucky. This is where it gets, well, really interesting for your actual money. Even if you pick a winner, there are these silent killers working against your returns, costs and fees.
Yeah.
Just a basic fact.
Yeah.
The market return is inevitably reduced by the costs of investing. And these aren't small things, are they? They build up.
Oh, they build up massively. Let's break down some of these active management costs that kind of creep up on you. First, you've got the obvious ones, the operating expenses, just the cost of running the fund. And interestingly, the average actually went up for equity funds over a 15-year period, even while the funds got way bigger.
So no economies of scale passed on.
Apparently not so much in that case. Then you have the hidden costs, mostly from trading portfolio turnover.
The churning.
Exactly. Actively managed funds might trade, almost their entire portfolio in a year, sometimes more. That adds maybe another 0.5% to 0.8% annually just in brokerage fees and spreads.
Yeah.
Index funds barely trade, so they avoid most of that.
Okay.
Well, don't forget sales loads. Those upfront fees, maybe 5% just to get in, spread that over, say, 5 or 10 years, and it's another 0.5% or even a full percent slice off your return each year.
Right, the entry fee.
And then there are the sneaky ones, the 12B1 fees. These are often buried. They're technically for marketing and distribution.
So paying for their ads.
Pretty much.
Yeah.
Not directly for managing your money better.
Mm.
That can easily shave off another percentage point per year, so you add it all up.
Okay.
The total all-in cost for an actively managed fund can easily hit, say, 2.5% a year.
2.5%.
Yeah.
You know, when you just say the number, 2.5%, it sounds kind of small, doesn't it?
Yeah.
Almost trivial.
Yeah, it does.
But then the sources talk about the tyranny of compounding. How does that seemingly small number become, well, devastating over the long haul?
It's brutal. That tyranny of compounding is key. Small cost differences year after year just explode into huge gaps in your final wealth.
Give us the numbers.
Okay, imagine $10,000 invested. Let's say the merger gives you an 8% return annually over 50 years. Simple math, ignoring costs for a second, gets you to around $469,000. Pretty good.
Not bad.
But now, factor in that 2.5% annual cost. That same $10,000, earning the same market return before costs, ends up as just $145,400.
Whoa, that's a huge difference.
Massive. It leads to the question Bogle asks, where did that $323,600 go?
Right into the fund company's pocket, basically.
Essentially, that 2.5% cost can eat up 1/4 of a long-term 10% return, or, put another way, an astonishing 71% of the extra return stocks might give you over bonds. It's just silently destroying wealth.
And it's not just the fees we see or even the ones we don't see easily. There's another big drag people often forget. Taxes.
Oh yeah, taxes. Huge, and often totally ignored by the industry selling the funds.
How do they come into play?
Well, the sources draw a really clear line here. Passively managed index funds are tax efficient. Why? Because they have very low turnover. They buy and hold.
So fewer sales, fewer taxable events.
Exactly. You keep more of your money growing. Active funds, the opposite. They're often tax inefficient. All that trading, that high turnover, sometimes over 80% a year,
Right.
means they're constantly realizing capital gains, and you, the investor, have to pay taxes on those gains, even if you never sold a single share of the fund yourself.
That seems unfair.
It's just how it works. Here's a killer example from the sources. The original Vanguard S&P 500 index fund. On a pre-tax basis, it beat 94% of its peers.
Pretty good.
But on an after-tax basis, it beat 97% of them.
Ah, so the tax drag made the active funds look even worse.
Precisely. The combined hit from expenses and taxes, it can be crushing. One calculation showed that over 25 years, your final capital value would have been only 37% of what you had had just getting the market return with no cost or taxes.
Less than half. Barely over a third.
Yeah, and this massive impact is almost completely ignored by the mutual fund industry. So you, the investor, really need to be aware of it.
Okay, this is starting to sound a bit bleak for active funds. Chasing stars is tough, fees are high, taxes hurt.
Right.
So what's the answer? What does this mean for you listening? What's the practical step?
Well, the sources point towards a really common sense solution, and it comes back to that quote. The greatest enemy of a good plan is the dream of a perfect plan.
Meaning,
Yeah.
stop chasing perfection.
Exactly. Forget the impossible dream of finding that one superstar manager year after year. There's a simpler, way more effective approach that tilts the odds back in your favor.
And that is the power of indexing.
Simple index funds.
Tell us about them. What are they exactly?
An index fund is basically just a broadly diversified portfolio, usually run at rock bottom costs. There's no brilliant manager trying to pick winners.
Oh, no genius required.
Nope. It simply buys and holds the securities in a particular index, like the S&P 500 or the total stock market. It's simplicity writ large, as Bogle put it.
And how do they perform?
The track record is, well, incredibly strong. The total stock market index, for instance, has beaten the average diversified active equity fund by about 2.5 percentage points per year.
2.5% per year. That's huge. That's basically the entire cost drag we talked about.
Exactly. The S&P 500 index beat active funds by 1.3% annually over the very long term and by a whopping 4.0% per year in the 15 years leading up to one study.
Okay, that's compelling. But, you know, playing devil's advocate, if it's that simple and that effective, why isn't everyone just doing it? Why does the active industry even exist?
That's a fair question. Part of it is marketing. Part is that allure of beating the market we started with. But fundamentally, why indexing works is crucial. It works mostly because of costs. The benefits of a passively managed index fund derive largely from the costs incurred by the traditional fund. An efficient index fund might lag its index by only, say, 0.2% a year, maybe even less.
Just covering its own minimal costs.
Right. It's a direct way to capture nearly all the market's return without that heavy drag of active management fees and the resulting tax inefficiency.
So even the pros admit it.
Many do. Even Peter Lynch, arguably one of the greatest stock pickers ever, said most investors would be better off in an index fund. Charles Schwab built a huge business and advocates for them. John Fossil, former head of Oppenheimer Funds, flat out said, people ought to recognize that the average fund can never outperform the market in total.
Wow, a direct admission.
Yeah, index funds might be boring. You won't brag about picking the right index fund at a party.
It's true.
But, as the sources say, the cost advantage of indexing will keep accruing relentlessly. And by using them, you are all but certain to outperform the vast majority of professional and individual investors alike. It's about quiet competence, not flash.
It really does make a lot of sense when you lay it all out. It's not just about avoiding bad luck with managers. It's about the structure of the whole system.
Yeah.
It seems like the industry itself is often set up to benefit the managers more than the investors, you know?
That's a really critical point the sources raise. They talk about this rift between ownership and control.
What does that mean?
Well, technically, the shareholders own the mutual fund. But in practice, the fund's directors usually just delegate everything management operations to an external management company.
So the people running it aren't the owners.
Exactly. And that creates potential conflicts of interest. We see this ratcheting up process for manager fees, kind of like what happens with CEO pay in big companies.
Fees keep going up.
Yeah. Warren Buffett estimated that fund directors, if they really acted like owners, could save investors maybe $10 billion a year. John Bogle thought it could be even higher, maybe $30 billion.
That's an incredible amount of money just lost to the system. It sounds like something needs to change fundamentally.
Ideally, yes.
So what's the fix for the system? And maybe more importantly for us listening, what can we actually control right now?
Well, the big picture solution, according to the sources, is getting back to real fiduciary duty. Meaning treating investors like true shareholders, like owners whose best interests must come first, not just as customers to sell products to. It's about that long overdue return to the ancient principles of fiduciary duty.
A shift in mindset for the industry.
Yes. But while we wait for that, the power you have as an individual investor is significant. The key advice is this. Focus not on future return, which the investor cannot control, but on risk, cost, and time, all of which the investor can control.
Control the controllables.
Exactly. Risk through diversification and asset allocation. Cost by choosing low-cost funds like index funds. And time by staying invested for the long term. By focusing there, you take back control no matter what the industry does.
That's empowering. So this whole deep dive really pulls back the curtain on the myth of the star fund manager, doesn't it?
It really does.
We've seen the allure is often just, well, looking backwards. We've seen how costs and taxes are these huge, relentless headwinds. And we've seen that a simple, disciplined, low-cost approach like indexing usually wins out. It shows that building a solid strategy isn't really about luck or finding some genius. It's about discipline. It's about common sense, choosing a path that puts the math in your favor.
Which leads to a final kind of provocative thought, right? It echoes something Benjamin Graham wrote decades ago.
What's that?
He said, the speculative public is incorrigible. In financial terms, it cannot count beyond 3. It will buy anything at any price if there seems to be some action in progress.
Ouch. A bit harsh, but maybe true.
Well, it raises the question. Given all this evidence, all this common sense showing a simpler, more effective path, why do so many people still chase that elusive star manager? Why do they crave the action? And maybe more importantly for you listening, what could you do differently, starting now, after hearing all this, to make sure your financial future is built on that solid, proven ground, instead of, just chasing the next hot tip or hoping for a miracle?